And welcome to the Win-Win webinar series, May 3rd, 2022. My name is Bill Bymel. I am your host, and I have three exciting guests with us for today's broadcast. For those of you that have joined us live today, thank you for being here. And whether you're watching on Facebook Live or live here in our Zoom webinar room, feel free to hit the Q&A and ask whatever questions you have of our guests today. We will try to get to them in the next hour. We have an exciting day ahead. I've got three very close friends in the secondary mortgage market, Tom Boren, Rob Hytha, and Fred Moskowitz with me. I'll give them a chance to introduce themselves in a minute. But just as a reminder, if you're just watching the Win-Win webinar series for the first time, we do this live in person on noon Eastern time, the first Tuesday of every month. We discuss all things real estate. I bring friends and colleagues from various facets of the mortgage and real estate world, primarily residential mortgages, non-performing, sub-performing mortgage loans, a business that we've all been part of for over a decade. And we try to combine that with real world perspective, where we are in the global economy and the US economy, the status of economics, both locally and on a macro level. And, I was saying to one of my guests earlier today, I really see the webinar series as a documentation of history. One of our jobs as investors in real estate and mortgage finance is to kind of read the tea leaves and predict the future. And so, I can remember what it was like in 2007 before the mortgage crisis of 2008. And, not to want to parallel too much, but we are in the middle of an economic transition in this country, something we're about to get into in depth. And so to document where things are for history is really a great opportunity for us to be here today. My name's Bill Bymel. I've got 14 years experience as a NPL first lien mortgage buyer. I have been in the real estate business for just over 20 years. I make my residence in Southern California, although I'm coming to you live from a hotel room in Miami Beach, Florida today. I'm going to give a chance for each of my guests to introduce themselves, and then we'll jump into our conversation. Tom Boren, why don't you get us started off?
Yeah, thank you. Thanks, Bill. Thanks for having me. My name's Tom Boren. I'm a Senior Vice President of Acquisitions at Aspen Funds. Been investing, buying, and selling primarily second mortgages for a little over 10 years now. Company that I work for, we wrap the mortgage debt that we purchase, both first and seconds, into funds. So we're primarily a fund manager at this point, but have been all through the cycles of these seconds. I'm home based out of Austin, Texas, but we're headquartered out of Overland Park in Kansas.
Very, very nice. By the way, my son sent me some pictures from a lake outside of Austin. I've got to talk to you about that after the event.
Great. Yeah.
Yeah, he says we got to buy there. Rob Hytha, how you doing? New dad. I mean, somewhat new dad, I guess.
Yeah, he's going to be 8 months old in 2 weeks. I'm super excited. It's our first. So you saw the picture at the top of the call here. Yeah, I'm founder of Fixed Notes. I teach investors how to invest in mortgage notes. I think that's reversed on my screen, but fixednotes.com. There's a lot of free content over there. But I started in the industry in 2011 with US mortgage resolution, buying primarily second position loans, also a little bit of commercial debt and some first position residential as well. And I've kind of went through with US mortgage resolution starting as an intern, all the different facets of the real estate notes business, which has gotten me to where I am today, and excited to be on the call with you, Bill.
Yeah, no, it's really great. Congratulations on the new baby. And by the way, the Fixed Notes, not only have we utilized your services and we love your work, but I think the organization the group that you've created of like-minded investors in your mastermind group, which I think all of us here are members of. And I think the first time I ever saw Fred Moskowitz speak was at a Fixed Notes mastermind. And I was so impressed with his work. And so I really appreciate all that you've done we definitely see the world in very similar ways.
Thank you.
Fred,
Yeah.
yeah, my pleasure. Fred, glad to have you. Don't forget to unmute.
Thank you. Thank you, Bill. Hello, everyone. It's great to be here, and really appreciate the invite and the opportunity to have a participation in the discussion today. My name is Fred Moskowitz. I'm based out of Philadelphia, and we manage funds which focus on junior liens, buying and holding mostly junior lien mortgages, some first position as well, but that's our main focus. And I've been in this industry for the last 12 years, so definitely have seen the changes, the changing industry, the changing market cycles, as well as the changing in the business and economic environments that we go through. And notes and real estate, it's like anything else. There are market cycles, and when you look at over history, you really get some interesting insights.
Yeah, no, absolutely. And there's a plug for your book, The Little Green Book of Note Investing. I was going to actually ask you to plug that as well, because I wrote a book, Win-Win Revolution. Oh, Rob's got them all there.
Nice.
Oh yeah.
Nice.
In case you run out of toilet paper, or are you just trying to keep up with your note investing book?
No, knowledge is priceless. Hanging on to these.
It is.
Yeah, it's so true. And that's another aspect of all of us. I think I know that individually and in group sessions that each one of you, I've had some really fascinating conversations about real estate, about the markets. Fred, you point out a very good fact that, we are investors in the secondary mortgage market space. Now, not to be confused with buyers of second mortgages. It's funny, many a girlfriend and ex-girlfriend of mine have confused when we'll go out I know that they're ex-girlfriends when I say I'm a secondary mortgage buyer on the secondary mortgage market, and then 3 years later they still think I buy second mortgages. But the good news is that you three actually do buy second mortgages. That's really your bailiwicks, although I know you each buy firsts as well. So today I organized this group to talk about the economy, where we stand right now, where real estate is, where the secondary mortgage market is, and particularly as it pertains to second mortgages. Second mortgages being those that theoretically could be foreclosable, and as a result, when they go non-performing, you can buy them at huge discounts. And there's huge arbitrage opportunities as a result of that. And, it's important to know where things are. It's important to stay ahead of the market, because we're buying paper as opposed to buying real estate. And the resolution time involved with buying that paper, in some cases, could be years. We really have to stay ahead of the market and the market moves in order to maximize our return, I think, for investors. So let's dig into the conversation. And as a reminder, if you have any questions, put them in the Q&A. I want to start with, kind of a global macroeconomic conversation. We have, since the beginning of the year, seen a huge increase in volatility in the equities, bond markets. Crypto was fluctuating quite a bit. Mixed reports on earnings. The last week alone, we've seen some huge losses in equity markets. The word recession, I've heard on the news and in writing more in the last 2 weeks than I've heard in definitely the last 10 years. And so, look, markets ebb and flow through cycles. We've been in the residential real estate market, we've been on a 10, 12-year upward trend in real estate values. The market kind of crashed in 08, 2009. It continued to decline. Real estate values continued to decline for a few years. And then we've seen an upward movement ever since then. We saw COVID come along in the spring of 2022, about 2 years ago. And we saw a dislocation in financial markets. There was some great buying opportunities. Markets are cyclical. And, we went through this black swan event called COVID, and the government stepped in and printed all this money. And it seemed like we had gotten through what could have been a really scary situation with shutting down the economy in 2020. But there may be, some long-term effects to printing tons of money, and we're feeling it right now. We'll get into the conversation of inflation later. Gentlemen, I'm going to ask you each, whoever wants to take it first, are we in for a major market correction this year? And what might it look like? Is it just stocks and bonds? Is real estate going to finally cool down? Because even through all this volatility, supply levels are low. Prices have continued. There's continued to be multiple offers on every real estate sale. What does this future look like? What does this year look like? Without assuming that, we don't know, obviously, none of us are predictors. Who wants to take that question first?
Well, I'll just set the stage first. I mean, we already are in a correction, over a 10% pullback, but less than a 20%. So the S&P actually fell back into another correction at the end of April. So just 22 days after the previous correction to start the year. So I looked this up and found that was the fastest reentry into correction territory since November 2008, which was obviously the turmoil of the financial crisis. So at this point, I think we are starting to see a parallel there, but back in November of 2008, the corrections happened 7 trading days apart. So I guess we have a little bit more runway this time. And I think that excess money printing and the more hawkish stance that the Fed is taking is hopefully going to stem things, but they talk about a crash landing. Maybe that's what we'll see.
Yeah, totally. Tom, what is your feeling about the overall, what this year looks like?
Yeah, I mean, Rob made some really good valid points, and that's great data to back that up with. I wasn't even aware of some of that.
Me neither.
Recently, but as far as I guess I can speak more on the housing side, because that's really what I'm looking at more. I mean, are we going to see some sort of correction in housing this year? In certain markets, yes, I think that we will. But is that going to translate into wiping out the gains that we've seen over the last 12 to 18 months in housing as well? That I'm not sure about. So I think certain markets along the coastal areas, are going to be hit, probably first and a little bit the hardest. But places like, I mean, speaking personally, like Austin, even if we have a huge recession over all fronts, I really don't believe that our property values in this area will go down just due to all the businesses that have come here and just the actual supply and demand, like you touched on earlier, Bill. So, I think we're going to see it maybe plateau, dip down in some areas, but I don't see a big housing recession coming in the near term.
Mm-hmm. Mm-hmm. Fred, what's your take on it?
Yeah, Tom made a couple of good points, especially about the housing market. Definitely geographic trends for sure, and
right.
There could be other changes, not necessarily in variation in pricing, but we could see variation in supply and demand. In other words, the days on market may start to increase for properties put up for sale, where instead of it being 2 weeks, it might go back to a more historical norm, like 60 or 90 days, and right. Different things like that, and the departure of regions where property sellers will put their property up for sale and have multiple offers way over asking price, and so that's starting to diminish a little bit. So it really, there's so many moving parts. And then we have the interest rates, mortgage interest rates. I feel that the rates themselves going up, it's not going to impact the pricing of real estate so much, but more of a think of it as an accelerator or a brake on the trend of the pricing, that whether the pricing's going up or down, the interest rate changes certainly impacts the purchasing power of the buyer. And so over time, you'll see an increase in change or decrease in the rate of change. So those are some of the variabilities, but there's so many moving parts. It's definitely going to be an interesting year to watch to see how this plays out.
Just
Yeah,
to hone in, sorry to interrupt you,
go ahead,
Bill,
Rob.
but to hone in on one of those moving parts, which is probably the most important in the real estate space, do you guys see a world at all where rents could go down? Because these non-speculative assets, these hard assets, are all based on cash flow, and rents are up, and I don't know how they're going to go down. So that really protects, I think, the real estate values for single family at least, and multifamily to some extent. So can rents go down, and what would that take?
Good question.
Certainly not in the near term. I mean, I don't see it.
I will say, and it's interesting because all four of us come from major metropolitan areas, so we're all like, Austin is a place that everyone wants to be, Florida, New York, the Philadelphia area. These are major hubs where people would rather be than not be, right? But if you go anywhere in the country today, whether it's like Dubuque, I mean, obviously, I'm sure there's places in Mississippi or whatever that you can buy a nice single family home for 150, 200,000. But when I think about any secondary or tertiary residential market in this country, first time home buyers, single family homes you couldn't find anything under 300,000. And that works for the average American when interest rates were 3% a year ago. We've already seen rates topping 5 on the 30-year. And given the obvious increase in rates that's going to continue throughout this year to stem inflation, we'll probably be north of 6. So that, that $1,500 a month payment for a $300,000 home is now well over $2,000 a month. And, to follow up on the question of rentals, there was a stat that I saw recently where it is actually becoming more and more expensive to own than it is to rent, and the gap is widening. So in that regard, maybe the predictors are correct that maybe those multifamily developers that are gauging to rent increases in the future and to make their numbers work, maybe they're right. Maybe rents aren't going down. Any thoughts on that? Any further?
Well, I definitely see, just my own experience. It's like everywhere I go, multifamily development is happening everywhere. New projects, buildings going up, and so that is helping with some of the demand as new rental inventory comes online and becomes active. But that's one of those predictors where those projects, it takes several years to go from getting a permit to actually being put into service, those rentals. And so that's a good leading indicator to look at. And another thing that, Bill, what you mentioned, the differential between for a person thinking, is it cheaper for me to own or to rent? Which one's better, right? You always have that dynamic into play. But I feel that in today's times, there's a large demographic of younger folks that are renting by choice. They rather rent, they rather have the flexibility so they can move around for job opportunities. They don't want the maintenance of a big property and taking care of that. So renting for them at a place where there's nice amenities and is in a good location is very appealing.
Yeah. And I've been if there's an opportunity for I have been hearing anecdotally some smart individuals looking at pricing of where things are. And especially in the last 2 years, you've got areas that have seen almost 40% increases in value. And some people are enterprising as they might be are saying, listen, if I can, for many people, their home was their biggest investment. So if they owned a house that they bought for 150,000 in 2015, it's worth 350 or 400, and they're able to take a couple $100,000 off the table, sell that home and move into a cheaper rental for a few years. I mean, that's really the smart play, probably.
Yeah.
I do worry about, one of the things that, and I've said this before, is, the future never plays out the way that we think it does. And we all live, wearing the glasses of our past. And in some ways, and, maybe it becomes almost a self-fulfilling prophecy that, the more you hear people talking about recession and market corrections, the more it becomes a reality. But I have been saying one thing, markets can change overnight, and I agree with you, Tom. I don't think we're going to see a retrace 30% in values if the market all of a sudden cools. You can't see that. You're never going to see that kind of correction overnight, because the demand still exists. And there was a lack of construction for a good decade, from 2008 to mid 2000 teens, where there wasn't a lot of construction, so we weren't supplying new. That said, in 2007 or 2006 even, I remember feeling as a real estate investor, the market felt a lot like it is now, and there was this sense that it could never go down. You got a sense that maybe the markets would get cyclical, but not that we would see the kind of boom and bust that we saw only a few years later. So does that give you guys any pause when you think of it from that historical perspective?
We in general just Aspen, at least, we've had many conversations about this. We're erring on the conservative side, regardless of what really the data shows us, just due to some of those historical things as well, and just and the unknown. So we're playing it as that could happen and planning for that, but we don't see it happening. We'll see.
I want to share one piece of data from the St. Louis Fed, and I don't know if I might have stolen this from you guys or whatnot. So this is a graph of total residential housing units under construction, and it goes back, as you can see, over 50 years. We have over 1.6 million residential units under construction today. This is the highest number of units under construction at any given time since 1973. So you combine that with a rise in interest rates, and the fact that we've reopened the courts and we're now foreclosing on homes again, and that there is 1 million forbearance owners out there that may have to rush to market to get rid of their potential foreclosures as they come out of forbearance. Those are just another indicator of the possibility that this huge demand with no supply could reverse itself in short order. Well, with that in mind, let's talk about inflation. I was born in 1975. I would guess that you guys are all in the 70s too. Oh no, Rob, you look like you were born in the 80s.
No, 90.
90s, oh my God.
1990.
Oh gosh, wow, geez, I'm old. Okay, I was a baby, so like the last time there was major recession, a major inflation in America was in the late 70s, early 80s, and that's what resulted in interest rates ending up in the teens by early 80s. I remember I tell this story all the time about my father coming home in 1981, jumping for joy about his 11% FHA mortgage, and and like, today we've been living with all this free money for so long, low interest rates, that it's almost like we've gotten spoiled. And then you hear stories about, what the end of a long inflationary cycle could be. You start to think about places like Venezuela, and I mean, they're quoting 7% interest rate here in the U.S., but I'll tell you from my personal experience, the overall cost of things is up way more than 7%.
Yeah.
So, what are your initial thoughts? And I guess the other question is it a bad thing? Can inflation be good? Or is it something that we need to be concerned about in the coming months and years?
I don't know if we need to be, it's getting to a scary point when you talk, approaching double digits, but, that would be almost hyperinflation. I don't know where the cutoff is for that. And that can certainly be bad, but mild inflation makes a lot of sense for the economy because it means that people spend money because things go up in price and you want to buy now, which creates, all of this new demand. Whereas deflation, the opposite, could be much, much worse because then everybody's waiting for the bottom and nobody's buying anything. And that velocity of money slows down. So I think that a healthy rate of inflation makes a lot of sense. I wouldn't call 7% healthy, but it is what it is, and we have to live with that environment, which unfortunately hurts savers and benefits debtors, which is tough for note investors because we're on that opposite side of the trade. We're not borrowing money, we're lending. We get back a lesser dollar with every repayment.
Right. Good point.
I think just one thing that I kind of think about inflation that I find interesting in this round is that there's also some things that are being reported as just simply inflation, where really we have huge supply chain issues on things that we've never seen before. That would be causing that without all the printing of the money, I think, over the last few years as well. So I just think there's different variables that are really contributing to what we're seeing in inflation right now. Because it's definitely above. I mean, if I had to look at inflation on my own personal household, it's well into double digits. I mean, so and part of that is due to supply chain issues and some other things too that just don't really coincide with what our regular inflation talk would be. So that's where I'm a little puzzled by what's really going to happen with this.
Yeah, that's a great point, Tom. Just taking a step back and looking at your personal economy in your own household, your family, and looking at what you're paying for things, right? And this is what people are doing. You might hear on the news that the inflation is at 7%, but for the person that's seeing their housing costs go up, the price of gasoline at the pump, the amount of taxes and property taxes that continue to go up, and all of these other costs, right? There's one thing that adds more smoke to all of this future we're trying to look forward to. The smoke is in front of our eyes, and it's this. Those inflation numbers, there's some bias to them. If we look at how they're calculated, it's something that changes. The federal government is not consistent over time with how they calculate that consumer price index. And so there's some influence there, I'll say, that changes depending on who's in charge in government and so on. A great resource I've been looking at is called shadowstats.com, where you can go in and look at consumer price index based on how it was calculated in the 1980s, consistently from back then to today, and they cross-reference that with what's the reported CPI. And so the difference is huge. I just took a look at it recently, where the CPI reported by the federal government is 7%. If you look at what it is using the 1980s method, it's 17%.
Yeah.
Wow.
Yeah. And so that's one way to, it's just an unbiased look at hard numbers, right? And you can look at inflation rate, you can look at unemployment, which is another one. Every federal administration comes in, the new administration comes in, they change how the numbers are calculated. And so everyone has different interests in how the numbers are shown. So it's just, I like looking at the hard numbers and seeing what that tells. It tells a different story than what we may be hearing.
Well, and I just love that. Thank you so much for sharing the shadow stats thing. I love learning something new every day because it just goes to show. I mean, if the government was still relying on the 80s CPI indicator versus today, the Fed may have been much quicker to raise interest rates, or they may have raised them a year ago, or the Congress might have looked at this second round of CARES money as too excessive. A lot of economists on both sides of the political spectrum and macroeconomic perspective are all saying that maybe 3 trillion was already probably too much, but the additional three that and the additional spending is probably really adding fuel to the fire. By the way, I just wanted to say that Melina Lopez is on Facebook Live. Let's give her a shout out. She says her favorite group of investors is watching. And Sri posted some great inflation stats. So as a reminder, if you have questions and you're here either in the Zoom room live, you can click on the Q&A below, or share a question as a comment on Facebook, and I'll try to get to it. The other comment that I want to make about inflation, and then we'll come back to some of the other questions that I have, is I said this as we were entering COVID. One of the things that's happened, we're all in residential real estate. We bought some commercial loans. I've been involved in commercial real estate, and I think there'll be opportunity in office, hospitality, and other asset classes of commercial in the coming years. But where we've all made our bones is in residential real estate. And, really the changing world that COVID created by bringing the workplace back into our home, by having us realize the value of our homes and or homes, having multiple places where you can reside, work. It can become a rental property when you're out of town. There has certainly a case to be made for a massive paradigm shift in the value of residential real estate. And historically, you look at major metropolitan markets outside the United States, such as where large quantities of people live, and residential real estate in those areas in those countries is way more expensive than it is even here, or it is at least at the level that U.S. is just now approaching in many areas. And so it's not like we're like totally ridiculous that that there may be a new level for residential real estate. That said, that probably pertains more to the top 10% of Americans financially that have a little bit more financial freedom, that may have benefited from the uptick in values both in real estate and equities the last couple of years, and the rich get richer kind of thing. And there still is going to remain some dislocation as a result of inflation and interest rates. So where is what do you guys have a prediction on any effect that the inflation aspect? I mean, certainly cost of living. If you're talking about an American family on a fixed income, maybe they're locked into a decent rate right now at 3%. Maybe they got in a year ago, or at 4%, or at 5%. So they're locked into that. That's great. But if all their other expenses are going up, is that going to be a cause for more distress? I mean, we're at historically low default rates, 2-3% across the board in residential real estate. It's still a huge market. It's still a couple $100 billion of debt in default. But as other costs of living, how can inflation have an effect, A, either on real estate, or B, more importantly, on our markets? And especially for you guys, second mortgages. Is a borrower who now has to pay 2 or 3 times the amount for their food or their milk, and now they come to their home payments, is there going to have to be a choice made? Are they going to choose to pay one mortgage or versus the other? What is going on in your guys' minds regarding all of this?
I can say we haven't seen any effect directly from inflation as far as from the borrower's perspective in our collection efforts or anything. We're still kind of riding the high of all the payoffs we've been seeing over the last, because of printing all the free money over the last 2 years. So that's not affecting us yet. I think that brings up a very good point. It's gonna be interesting to see. I mean, people that are kind of on that cusp of what they can do, but we do have a lot of fixed income borrowers also. And so I don't know how that's going to play out, but I think you make a great point.
Mm-hmm. Mm-hmm.
Yeah, one consideration that we make in collection efforts is really to try to be not a financial advisor, like in the sense you might think, but an advisor in a way to help them bring their balance sheet, their personal economy into a good balance where they can pay their mortgages and pay their bills. And that process is going to become much more difficult as these fixed costs rise. But I think it is an opportunity as an entrepreneur in the secondary mortgage market to create these win-win resolutions, as the name of the show entails, where the banks haven't been able to. Because I think that out-of-the-box thinking that we have as private investors lends itself to creating these creative solutions with our borrowers. So although it's going to be more difficult going forward with rising costs, I think it's all the more necessary for our business.
Yeah, no, absolutely. That's great. No, that's a good point. And look, I also now want to pop up one more share. It's actually from your shadow stats, by the way, Rob. Sri Gan, I'm going to give him credit for this because he sent it over in the chat. But this is the same thing Fred had indicated with regard to the CPI difference. Is see the difference between the red and the orange and the blue line on CPI. The same thing with shadow stats showing this with regard to consumer inflation. We all have been hearing this 7-8% number, but if you gauge the inflation based on that 1980 based alternate way of looking at it, then inflation is way above 15% right now, more than double the way we see we're quoting inflation today. So that is something to keep in mind as we look at it, that maybe the data that we're seeing isn't, it's hard to compare it to history when it's not the same comparison. It's so unique, it's so scary.
I would be concerned with shadow stats adjusting for the supply chain issues. That was a great point that I didn't think of that Tom brought up. It'd be hard to calculate that out. So maybe, hopefully, that's overly stating the CPI. We'll see, though.
Yeah, hopefully. Fred, did you have anything else you wanted to say about inflation, or can I get into the secondary market?
No, let's move on.
Yeah, because what we do, all of us, is buy first and second mortgages, mostly on residential real estate. We buy in what we call this secondary mortgage market, and it's really just a group of investors getting together, either through loan sale advisors or through our personal relationships with each other, and selling these loans in pools and either individually or in pools. And so the four of us spend a lot of time trading with either larger investors looking to sell or with each other. And so, I want to bring the conversation into where things are just even in the last 30 days with regard to changes in the market. Because as I have told my partners and many others, we are in transition in credit markets. Any rise in interest rates or a severe change in interest rates, the way that we are now going through it, it's obvious that major interest rates changes are happening and will continue to happen. Will create dislocation in liquidity markets, especially in credit liquidity of markets. As a setup to this first question about the status of the secondary mortgage market, I'm going to give you a story about a conversation I had just 2-3 weeks ago with the loan trader at one of America's largest loan originators. I don't want to say their name because you guys all know who it is. But they do quarterly loan sales directly from this originator. And they are usually a combination of non-performing loans and then some performing loans that may not have sold or qualified for a government purchase or something like that. So it's usually two types of loans: performing loans that are originated in the last couple of years that are performing, but maybe have some scratch and dents and compliance concerns, whatever, and non-performing loans. And obviously, a non-performing loan should sell way less in terms of, if it's going to be discounted from face value, that discount should be way more severe in a non-performing loan versus a performing loan. Well, for the first time in this loan trader's career, last month, those positions got reversed. And there was actually a bigger discount having to be given to performing loans, cash flowing performing loans without any type of default. Those sold about 100 basis points less than the non-performing stuff. So what does that mean? That means that there's a dislocation. And what is your guys' take on that fact? And where are you guys seeing the transition of the secondary market? Are you modeling for this in your seconds bid? And where have you seen pricing, especially on seconds? Because I don't follow seconds. Have you seen any shift in pricing, either in performing or non-performing seconds in the last 30, 60 days?
Quick follow-up question there, Bill. What vintage were those performers? I'm assuming they're very low interest rate, but what?
Very low interest. Yeah.
They originated within the last year or so?
Within the last 4 years, so okay. 3 to 4 years. So you'd be range of 3 to 5% performing loans. So obviously below where any new originations are going to occur from here. And that's obviously you have the risk there, I guess, is that if a loan goes bad, you have to deal with it, and it's a low interest rate loan. Well, obviously, if you're buying a 3% mortgage, the guys that have been buying these low interest rate performing loans have been using highly leveraged pieces to finance those. And so it makes sense that as interest rates would increase, that would become less possible. Tom, where you give us a start? Where have you seen things change, if at all, in the last 30, 60 days?
Yeah,
and actually, how are you accounting for it?
It started before that. And so I've seen some changes over the last 30 to 60, but really it's what changes that we've seen over the last like 18 to 12, 12 to 18 months. And we're having the same, in our market, we're having the same supply and demand issues that we're seeing in housing as well, very similar. So there are too many buyers out there with too much cash that can't place it in products. So what it's done is it is just skyrocket prices on non-performing, specifically seconds. Performing always kind of stays the same, but Rob already touched on it. It's really based on the interest rates. You do get some other people that get cheaper money that are willing to take a lower yield, but in general that stayed pretty much the same. But on the non-performing side, I mean, I've seen a trade recently where non-performing second liens were trading above par. For non-performers due to the arrears, because these are old 2008, right. 2012 vintage, but you have this issue where you've got statute limitations on one side that's compressing you from, for your arrears from the beginning, and then you've got reinstatement risk on the other side that, you have to make sure you're not buying a loan that's recently delinquent if you're paying, above 50, 60, 70% of UPB. So it leaves you with this sweet spot of like, 6 to 4 years of arrears that you need to have to be able to hit prices like that. And hopefully there's more, as long as you're not subject to statute limitations. But just because so many people have so much money, I think that there's some out there that are maybe have newer funds that really just need to deploy that capital. They're not as concerned about what they're actually going to be able to pull as a return out of it. To them, they want to deploy it rather than have to return to an investor. So that's created a little bit of an issue for a fund like ours, where we don't do that. So for us, it has to make sense every time, and we've lost some bids that until unimaginable pricing. So
Yeah.
and that's
Yeah.
been over the last year. So
Go ahead, Fred.
I agree with you, Tom. A big factor is the cost of capital of other investors and how that runs their business model, and that will dictate how aggressive or how conservative they need to be with bidding. In our own funds, we've definitely shifted more from focus to performing loans. That's been our main focus as a result of the pricing differences and the supply and demand. And really, in reality, for a successful investor, you want to be able to operate your business in any market conditions and be flexible and be nimble so that you can adapt and have a look ahead at what's coming, but still continue to operate in a profitable manner.
Right. Rob, what are your thoughts? What are you seeing in the market?
Well,
And you
something
just
that
did a couple big trades this year. You sold out too. So you have
Yeah, we sold some loans, bought some loans. We're definitely seeing pricing in line with what Tom said, increasing non-performing second values. A lot of that is due to equity improvements, but probably more so the supply-demand imbalance. So I think for the most part, our pricing model does reflect the equity adjustments, but doesn't quite reflect the supply-demand imbalances. So that's really where you have to go in and tweak some of it manually to remain competitive. But something I learned from your show, Bill, when you had George Newberry of AHP on, was that to get the best prices on cash flowing loans, you sell to the biggest possible buyers. To get the best prices for non-performing loans, you sell to the one-off buyers. And I thought that was an interesting, it's all based on the cost of capital. But it would be interesting to see with this recent trade where we saw that inversion of performing and non-performing pricing. And you kind of alluded to this, that the performing loans that they sell to the secondary market were not able to be packaged or securitized. So those performing deals probably went to smaller investors who couldn't pay as much as the guys with the really, really low cost of capital. But that's an interesting thing to keep tracking here. And I'd also be interested to know if we've seen the peak of non-performing seconds pricing because of another thing I learned from your show, Bill, the lifting of these accounting reliefs. And once those go back into play, there's going to be a lot more charged off loans that need to be sold to bring the bank balance sheets back into a line that makes sense. So hopefully there'll be more supply, pricing will come down, and maybe we've seen peak non-performing second pricing. But I don't know if you guys agree, if that's.
I would have to think that we've seen the peak of all pricing. I mean, I could be wrong, but I would have to think that in all regards we've already passed the peak. And that's what I'm hearing from the loan sale advisors too. We kind of hit that pinnacle. Tom, Fred, what are your thoughts?
Well, I guess it's a little different on our side with the second, especially looking at the non-performers, just due to the arrears portion. I mean, the larger guys and originators you can only go so high, 106, 107 a par, because you don't have these huge arrears, on the back of them. But in seconds, I mean, some people are valuing in some, non-judicial states. I mean, they're doing, percent of payoff, and some of these approach 60, 65% of payoff. They're willing to go. That puts them up into 120% of UPB. I've seen that go on some single ones. And Rob, you make a great point. Those are typically the smaller buyers. They might have a self-directed IRA. They see one loan that stands out, or a few that they're willing to do that with because it makes sense for them.
Most likely,
we're asking. We're kind of in the middle.
Right.
I
So,
thought
and what have you ever paid over 100%? Any of you of UPB for a second non-performing?
I have in my personal portfolio, but it was more for developing a relationship with a local bank. I was their guy who was, and it was also somewhat of a misrepresentation on the bank's end. They gave me a payoff balance, and did not give me the UPB. So we had our initial conversation all based on payoff, and I was under the impression it was balanced. But then at the point where we got to closing the deal, it was really more about the relationship, and it wasn't hundreds of thousands, it was in the tens of thousands. And it was an REO play, deceased borrower, vacant property. So it was really more about the value of the land. So that made sense. But other than that, not with my portfolio management clients. We're not paying more than par value, especially on non-performers, of course.
While I want to go a little into, because I don't get a chance to get three of the great second lien buyers together in one sense, but I'd like to go around and ask you a couple of questions. First is, what percentage what percentage of the seconds you're buying, non-performing seconds that you're buying, are you reperforming versus some other type of workout, either a short payoff or something like that?
I think Tom's going to have the best numbers here since he runs the full life cycle.
Our numbers have changed a little bit. Before we had more modifications and less payoffs, but over the last year and a half, that certainly increased. But I would say modifications, I'd really have to go back and look at the data, but I think we probably modify 65 to 70% of loans and get them reperforming, with another 15 or so paying off. And that payoff number is probably a little higher over this last, year and a half. And as far as actually taking all the way the steps, taking a property back, we're less than 20 properties total that we've taken back in Aspen.
Oh, wow, 20 properties. So that's a very small percentage.
Mm-hmm. Yeah, less than 20.
Wow. Fred, what about you?
Yeah, we also have seen a dramatic increase in exits out of notes via payoff or either due to refinance or sale of the property, and that's just a product of the current real estate and refinancing market we're in. So it's going to be interesting to watch how that is impacted. But historically, in all of my years in the mortgage industry, we've never seen that before. So many payoffs happening, and so it is interesting, in particular on smaller balance loans where it might be a little easier for a borrower to come up with the payoff, and it's happening. So it's been a unexpected surprise, and it will be very interesting to watch how that proceeds over the next 12 to 24 months.
Enjoy the harvest, in other words.
Yeah, it's got to slow down. I mean, it's going to have to slow down.
We saw some payoffs on a recent trade in the interim servicing. We're getting payoffs from our seller pass through, which is awesome. They're just the layups that we get as a result of just the process is already underway, and they get paid off before the servicing transfer. On our end, though, it's hard to say because my portfolio management clients, for the most part, will collect for about 90 to 120 days, and then we'll rarely pursue foreclosures, and we'll often flip those to secondary market participants, like some of the guys on this call, of course, who are more apt, more local, more situated for foreclosures, taking back REOs. But I think within about 120 days, we're seeing maybe 30% of the portfolio moving in some positive direction. And like both of you have said already, payoffs have been a lot more active, at least recently. Mods are kind of the fallback. We like to get the payoffs to redeploy the capital. And then if a payoff is impossible, a mod with a down payment is also definitely what we're looking for.
What I love about you guys, you're all professionals and you see the world the same way as I do, which is that, you don't get caught up in the idea that the average person does, which is that, there's no end to this. We all know that markets will turn. I think about my son who's 30, is looking to buy his first house in Los Angeles, of all places. The first time home buyer level in LA is a 7-figure purchase, $1 million or more for a first time home buyer. And I just keep telling him, please just wait. If prices do cool off later this year, and let's just say they don't even reverse. Let's just say that prices, the new construction starts coming to the market, interest rates rise, lowering the demand of the end user. You've still got these corporate buyers out there buying, so there's still plenty of cash out there as well. Let's just say the market just cools. And I think that actually more MBA and NAR both have a prediction, that there will be a cooling this year. So like you won't see the 12 to 15% or 20% increases. They're saying it's going to be more like a normal 5% increase. So that's a major decline in the thrust of the market. How do each of you model for that? How do each of you then account for that when buying second mortgages? And how does that differ? I know you each have bought some first too. Is it different, or is it the same kind of perception?
We never accounted for the fast appreciation of the property. So we saw that as a bonus, and that was great. But we never put it into our pro formas or into our expectations for collections with borrowers. So for us, we kind of just stay on the same path. It doesn't really affect us in how we forecast.
Okay.
Yeah, I think what affects us more is the supply-demand imbalance, because all of our models already account for equity, and that's really where we're going to see the biggest changes. And I don't know who said it first, but there's no such thing as a bad note, just a bad price. And we're ready to take on underwater borrowers if that comes to pass here.
Yep.
I actually have to go ahead. I was going to attribute that quote to John Dario. That's the first person.
Oh, nice.
To say that. Go ahead, Fred.
I think that that environment with a lot of underwater properties, that's what we grew up with in this industry, right? All of us, we've been through that. And it's, as I said earlier, it's about being nimble and being able to adapt and be flexible so that you're well positioned for the current conditions.
Got it. Yeah, absolutely. I hear that. Well, there we are. We've been an hour together, gentlemen. I wish we could talk forever. We're going to finish up today with the usual thing we do now on my webinar series is I'm going to ask each of you to make a prediction, whether it's funny or serious. It can either be funny or serious, but make a prediction. What's something related to the world, to the economy, to real estate, to your mortgage business. We'll go around the horn, and I'd love you each to give me your thoughts. Who wants to go? Fred, you go first. I'm calling on you first.
So here, yeah, I feel this in particular in the times that we're in right now. We're coming out of the pandemic. I feel that anything that's related to tourism industry, entertainment industry, and on the real estate side, right? Those areas are coming back so strong because the businesses are able to operate again. There's so much pent up demand from consumers. They're going to be strong. So anything related to that is going to do really well over the next 12 to 24 months.
Very good.
Yeah.
Tom, what about you? Oh no, Rob, you're up.
Well, I was going to agree with Fred there. I think that there is a pent-up demand, and I think that's going to, this is kind of a pivot, but somewhat related. I think in the next 12 to maybe 18, 24 months, we'll see NFTs become mainstream. I think we're kind of going beyond the speculative JPEG on a blockchain, the collectibles. I think that's run its course, and the next iteration, which is already happening, is focused on utility in a bunch of different niche applications. If you're following that side of the crypto market, Gary Vaynerchuk has had a bunch of success with his NFT Series V friends, which basically serve as a ticket to all of his live events. So if you're a V Friends holder, you own this NFT, you've got this VIP access to all of his future events, and it's transferable and it appreciates in value because of its utility. I'm most interested now in an NFT project called StepIn. I don't know if you probably never heard of it, but it's experiencing like parabolic growth right now. It's a Web3 fitness app that pays you to walk or run. So they call it move to earn instead of play to earn. Like Axie Infinity was an NFT game that totally blew up in a bad way eventually. It all crashed. But this move to earn concept, essentially you buy an NFT of a shoe, and then when you use the app, you get a limited amount of time to earn money by moving, holding this NFT sneaker. So currently the prices are insane. It's $1,500 to buy an NFT at the floor price, but you're making like $50 a day. So your break even is in a month. So it's unsustainable, certainly, but it's such an interesting concept because it's bringing people who aren't like crypto bros into the NFT space because it's about exercising. They have a whole carbon offsetting program to be environmentally friendly. And it's amazing because there's all these like women who have never even bought a cryptocurrency before who are interested in it. My wife wants to, I can transfer her a shoe, then she can walk and be earning. So it's kind of a weird thing right now. And people are just starting to figure out how it can be focused on utility and use the blockchain in ways that are actually interesting and not just speculative. But I think that's going to become mainstream probably before the end of this year. I think.
Wow.
We'll see. It might age
So-
like milk.
On the NFT with the shoe, you get the NFT as a shoe, but then you actually move with your phone and record, and that's how it records.
Yeah,
steps,
use
or-
the GPS, and they have a bunch of like anti-cheating type of algorithms for the accelerometer and everything. So you just open the app and start a workout, and then depending on the stats or whatever of your shoe or how many shoes you have a certain amount of time where you can actually earn. So in the beginning, if you have one shoe, you get 10 minutes of working out, and 10 minutes, believe it or not, will earn you about $50. So right now, there's the app is very addictive. They have a lot of gamified components that encourage you to reinvest because then you can earn more. So in the last week, I've been like pretty obsessed with it, getting my my little stable of my closet of shoes up to the point where I'm earning like 150 a day. But I also reinvested all of the earnings that I was making along the way to get there. So we'll see what happens, but it's, you never want to invest in a project like that with money that you could afford to, you can't afford to
play
lose.
money.
But
Yeah.
we'll see if it breaks even.
I
in a
love
month,
it.
will-
I think it's a
that'd be
great
cool.
prediction because DeFi is definitely. I'm giving up fighting DeFi. I'm gonna start putting some more money into crypto. I think now finally.
Yeah, well, it's a good entry point at the very least. It's came down a lot, but Warren Buffett just had some, and Munger also, they had some really bad words to say about Bitcoin recently. So maybe look that up before you invest. They're not thrilled at all with crypto. They think it's a scam.
Well, I mean, one could believe it, but certainly a lot of the crypto that's out there could theoretically be, the pets.com of the future, right? So like, that there was plenty of early believers in tech and whatnot in the 90s when the internet first came out. And when it crashed, a lot of the companies went away, but there were winners and losers. Tom, what's your prediction? By the way, that's step in. Oh yeah, good. You put it in there in the chat for Bella. Perfect. Tom, what's your prediction?
I 100% agree with Fred. My prediction is not nearly as cool and as fun as Rob's. So I'm going to go, I guess, a little more kind of what we're seeing a little bit, so to be able to predict off of that. But I really think once the stock market, I think the market's in for an interesting correction, far beyond what we're seeing here. And I think that just with the changes of the demographics of our country and the ages of different groups of people that invest, alternative investments, I think in general, are just going to really come more to light. I think there's been a lot of companies that have done good jobs of making it more mainstream, but even just looking at what we're seeing as growth on our wait lists, for all of our funds are waitlisted at the moment, and that's due to this kind of this need that people want to get out and get to alternative investments. And we've been seeing, I mean, we have leads coming through social media, people that we've touched once or twice that now want to invest. Or before it was a much more hand-holding type deal. Of course, our credibility has grown, but I think there's an actual shift to people starting to understand and not be afraid of alternative investments. And I think we're going to see a big shift to it over the next year.
Right. No, I agree. It does seem interesting how, the next generation seems very adaptable, very willing to try new types of investing. And, and obviously even the older generations have gotten to that point too. But definitely, it's interesting to see like my kids' generation and their Robin Hood and talking about things and whatnot. It does remind me a little bit of when I was in college and I had friends that were like hadn't even graduated from college and made $1 million on their stock options for their internship. But and then of course all of that disappeared within a year or two later for most of those people. So on paper they were all worth a lot, and then there was a crash. My prediction, I don't want to be too much of a Debbie Downer, but mine probably is more associated with geopolitics. I'm very concerned about the Ukraine situation. And as somebody who has a son that's in the U.S. Army, I am super, super concerned with the U.S. getting involved in what's going on in Eastern Europe. So, my prediction is that there's more uncertainty in that regard. And that could be another one of the items that makes buying loans at a discount on the secondary mortgage market even more discounted. So I guess, with every bad situation, there presents opportunity. Gentlemen, I really appreciate you being here with me today. And for all of you that attended live or are watching the replay, look up these guys online. You'll find they each have their own following. They're very accessible. And I look forward to seeing you all at our next conference. And thanks so much for attending.
It was fun. Thanks, guys.
Thank you. Thank you.